financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, April 20th. Here are the top market stories that we're following for you at this hour. Tesla's margin dent. You got Elon Musk leaving the door open to more price cuts, dragging global auto stocks down. What a price war could mean for the markets. And a mixed deposit picture. You got a slew of regional banks out with numbers and a murky deposit landscape. We're going to break that down for you as well. And the DOE lets the sunshine in. We talk exclusively to the chair and CEO of Sunnova on his company's $3 billion loan guarantee from the government and how it can help spread more solar panels across the U.S. The stock popping by about 2%. From New York, I'm Alex Steele with Danny Berger over in London. Guy Johnson is off today. Danny, we are under some pressure here in the markets. You have jobless claims rising just a little bit. Obviously, there are areas that are under pressure, like autos and potentially housing.
Yeah, well, we did just get data now coming in, Alex. Let me bring it to you of U.S. March existing home sales coming in at 4.4 million. That's a 2.4% growth. It is ever so slightly weaker than the estimate, which was 4.5 million. But it basically is in the middle of the range of those we surveyed from Bloomberg. Alex, it is some strength that we did see in pending home sales feeding through. But the question we keep grappling with is the consumer strong? Are they still buying those big ticket items?
Yeah, and to be fair, you know, D.R. Horton is up like 7%. They had better than expected second quarter results and guidance. Have we already kind of hit the low for the housing market and then we're kind of moving back up? And our auto is really getting hit because of Elon Musk, not necessarily a broader underlying issue. I don't know. We'll break it down.
Well, the concern is that if Tesla, a car company with immense brand loyalty, has to cut prices, is that a bad leading indicator for the rest of the corporate world? And Alex, that brings us to our question of the day. Has Tesla started a pricing war? Is every automaker going to have to follow suit now? Joining us to discuss is Bloomberg's Detroit bureau chief David Welch and Stefan Nicola in Berlin. David, let me start with you. I think Elon Musk himself would probably hate this question because he said before, you're covering it wrong. We're not starting a pricing war, but is he to some degree? Is this going to ignite a pricing war?
Well, he said it's not, so that's the last word, right?
Of course.
So, look, he's got a lot of different dynamics that I think other car companies don't. If you look at first quarter sales numbers for all the car companies, they did pretty well, and pricing held up pretty nicely. What Tesla has going on is, one, he is fighting for market share, and I think demand is softening for their vehicles. Their inventories crept up from 3 days worth of vehicles to 15. 15's not a lot, but Tesla never really carried inventory. They don't have dealers with big lots full of cars. You order a car, they deliver it. And their revenue growth has gone down 5 quarters in a row now. So he's dealing with a couple different things. In addition to that, Berlin and Austin, Texas plants are not at full capacity yet. He's still ramping those up. That means he's going to have even more vehicles that he's going to have to try to push in the coming quarters. So I think he's got softness, he's got capacity coming online. That's not the same situation other car companies are in. That doesn't mean they won't get pulled into a pricing battle, but he's got some different dynamics that he has to wrestle with.
Okay, fair enough. So, Stefan, when I'm looking at all the traditional OEMs, auto companies, are they down because of Tesla, or are they down because of Renault, or why are they getting hit so hard today then?
Yeah, well, you know, Elon Musk may say that Tesla hasn't started a pricing war, doesn't want to start one. But what we can't ignore is that Tesla's moves have repercussions all over the auto market. They're still the EV market leader. So what they're doing on EV prices will affect all other companies. If, you know, I may take you down to France, Renault this morning reported sales that in the first quarter that beat analyst estimates, and it confirmed its full year guidance, but the shares still slumped today, the most in more than 6 months, because of concerns overpricing that Tesla started. So, you know, you just can't ignore what Tesla is doing. It has repercussions all over the auto sector.
And Stefan, one of the points that David made that I want to ask you about is this idea of the different dynamics that automakers are facing. Tesla is able to, at scale, make profitable vehicles. How in danger are the Renaults of the world if they need to start cutting?
Yeah, of course, Tesla still has sort of industry leading margins, especially when it comes to EVs, even as they've been decreasing a bit. Renault is in a way different position. Its margins are way lower. It's producing cars that are generally lower priced. Its main market is Europe, where we have inflation concerns, we have high energy prices, a cost of living crisis. So, the concern at the lower end of the spectrum is a bit higher. But we also have to know that not just Renault is falling today. It's Volkswagen, it's Stellantis, it's BMW, it's Mercedes. So, lots of companies are affected by the pricing concerns.
Focusing on Tesla for a second, David, and Stefan made the point that the margin room is obviously so much nicer and bigger for Tesla, right? Like 11% versus, say, a 6%. But nonetheless, the margin re-rating is going to have to come with a valuation re-rating too. Like, you can't have the valuation that Tesla has if the margins are coming down. How are you going to look at the two?
So Tesla has traded as sort of a super premium luxury car company for a long time because their vehicles are very expensive. They trade at multiples even higher than Mercedes and BMW. So I think that's what we may be seeing right now is with the softness in demand and lower pricing for them, lower margins. I think they're going from what was this hot growth company and this technology story to something that is maybe more like a car company. And you notice on the call yesterday, Elon tried to talk about autonomous driving and full self-driving as a way that would bring in more revenue and more business. He talked about stationary storage, which has nothing to do with cars. That's about storing energy on the grid to make a case that they're not just a car company. But right now, the way the shares have been trading down 10% in the last 3 trading days, the market may be starting to perceive that. I do think they will drag pricing down for electric vehicles in the U.S. market especially. But do they drag down pricing for gasoline-powered pickup trucks and SUVs? They don't make one, and there's a lot of pent-up demand for those vehicles, so I think there could be staying power in pricing. But overall in the U.S. market, pricing has to come down because we've been at record levels for a year. It just can't stay that way.
David, will this ignite calls for Elon Musk to concentrate more of his time on Tesla? Just moments ago, we saw the SpaceX rocket launch. It appears that it exploded. There's the concerns about Twitter. Do the calls for Musk to come back home, if you will, get louder?
Well, they may, but I think when you invest in Tesla, you have to realize that this guy has SpaceX, he's got Twitter now, he's got the Boring Company, he's got all these different things, and you sort of buy into the story that he can balance all of these different things. And I think so much of the value of the products themselves and the stock is tied up in his genius and his brand name that there aren't going to be calls for him to really change much, and he'll ignore it anyway.
Yeah, I was going to say, when aren't there calls and when he doesn't ignore it? Hey, Stefan, last word to you. When you take a look at the auto space, which auto company is set up best to defend itself if Tesla is triggering this price war?
Oh, that's a tough call, but obviously the ones I think on the top end of the spectrum, the companies that have luxury cars and can charge luxury prices, Mercedes-Benz comes to mind, Porsche comes to mind, BMW to a certain degree, they may be shielded a bit from those pricing concerns, at least to some degree.
All right, guys, thanks a lot. Really fun conversation. You're looking at S&P up by 0.5%. We're really seeing, GM, Ford getting hit hard here. David, Stefan, thank you both very much. All right, coming up, we're going to take a look at the market repercussions of a Tesla price war. Also, what does it say about the cycle, and how much downside then could there be in cyclicals? Linda Dussel, senior equity strategist over at Federated Hermes, joins us next. This is Bloomberg.
We see inflation moving into the rearview mirror. The Fed is going to want to make sure this inflation really gets down. So I think the idea that they're going to pivot is a mistake. I think they're much more likely to pause, hold rates at an elevated level, and continue to see the economy decelerate. That's going to create further tightening.
That was Blackstone Group President and COO Jonathan Gray joining Bloomberg TV earlier today. So let's get to the question of the day, because it also kind of has to do with inflation. Has Tesla started a price war? Linda Dussel, senior equity strategist over at Federated Hermes, joins us now. You know, Linda, I know you don't talk specific names, but if we're in like a price war for EVs, in a weird way, is that deflationary? How do you look at that?
Yeah, sure, it's deflationary if you're a consumer and you're looking to buy an automobile. And as we know, in these last couple of years with COVID, first you couldn't find a car, and then there were too many cars. You know, there was a glut of used cars, et cetera. And so now we have Tesla basically saying we'll sacrifice margins in the name of using this factory space that we have. So as long as the consumer still has money, then yeah, that's a blessing. That's a piece of disinflation. And they'll probably take them up on it, too.
Yeah, exactly.
Tesla, of course, has all of its own issues to deal with, as does the EV space in general, Linda. But I wonder if you look at this and say, okay, maybe this is the first sign that corporates are losing pricing power.
Well, it's definitely a strong sign, yes, that corporates are losing pricing power. And it's one of the reasons why I think we're stuck in a wide trading range now here for 6 months and counting. You have to really pick your spot. You have to really study your companies to get the sense of whether they have something that consumers or whomever their customer is wants, that they can keep those prices up, because some of their own costs will be stubborn. And, you know, and that's one of the first things to watch really on the downside of an economic cycle, is that margins start to get hit. Now we really need to watch sales and make sure sales are okay, because you can hurt your margins, but if your sales stay up, then your earnings per share may still be okay.
Right, which is probably what, you know, Elon Musk is betting for on that, which kind of leads me to the broader impact, right? So how does this affect the broader market? I'm looking at Ford, I'm looking at GM. Those stocks are getting hit really hard. Those cyclical guys. How does that feed through to the overall index?
Yeah, well, of course, now the overall index has been, one of the reasons why that it's been stuck in this trading range is because it's heavily weighted in terms of the largest names. And the largest names, and this is particularly in the tech sector, which arguably you could call Tesla a tech stock, they've held up well, though, on the norm. And so one thing to be concerned about as we get deeper into this earnings season is that next week we're going to hear from more cyclical stocks and more tech stocks. And so that should be a really interesting week to watch the earnings season progress. I know that cyclical stocks in general have been bid down already now to as low as what they were back in October. So a lot of the air should be out of them. So why would you think a surprise on the downside is a surprise, you know?
Do you think then that perhaps equities, I mean, they really, along with treading water, just defying gravity, when we have a market that's expecting a recession? It goes back to this thing that Bank of America said, Mike Hartnett, that we're over optimistic on the likelihood of cuts, but not pessimistic enough on what would cause the cuts. Do you think this market should be pricing in something more of a recession?
Well, we think that the stock market is pricing in a mild economic recession, which is kind of what we at Federated Hermes expect. And what makes it difficult in terms of how to navigate a market, you really would like it to move somewhere. You're not happy when it sits there, is that we have something. I saw a word just the other day called, I thought was really cool. It's called slowflation, a slow economic growth rate. Slow growth, maybe 1% GDP this year or next, and that's what we're suggesting. And then inflation that stays stubbornly higher than what the Fed wants. And that's what we think the next number of years may hold. So you will want to pick your spots. And if the Fed pauses, you still want to be in defensive stocks. That's what history tells you.
What's the difference between slowflation and stagflation? They sound the same.
Well, a slowflation is you're having an economic growth of some kind. You're having a slow economic growth. You're not dragging into recession. If we have a technical recession, which we do, priced into the back 2 quarters of this year, we still have a full year of 1%. That's slow. If next year we don't see any big bounce or any big decline, then that's slow. If we're seeing this disinflation that we spoke of with Tesla, that's good. And as you mentioned early in our talk here, the housing market seems to be reviving. Mm-hmm. That's not stagflation, nor is stagflation unemployment at these low levels.
I think that is such an excellent point, Linda, and it's a point that perhaps doesn't really have a clear playbook. We talk about the 70s, whether that's a corollary, what to do in that stagflation scenario. So how do you think about positioning? How do you think of what becomes your guiding star if we enter an environment like that?
Yeah, sure. I mean, if you were in the mindset of slowflation, then you'd say, well, what worked historically? And what worked historically were these same defensive sectors that, interestingly, year to date, up until this month, were underperforming. And you're starting to see the staples, the healthcare, the utilities maybe poised to come back to life again after being beaten up a little bit. And importantly, the energy sector coming back. If you're expected to be stuck in a range and you don't see good catalysts outside either which way, you should look for income. Defensive, quality, dividend-paying stocks have been beaten up for you in the first quarter of this year while everybody was running over to the big cap tech stocks. And so now you're getting some good prices too, and some good yields. So that's the smartest thing we can think of, plus cash.
So Linda, just one more quick question, and because you mentioned housing, and I wonder, I know you saw it slowflation, but if we just look at housing, it's not only that it's bottomed, but it also feels like in some areas it's re-accelerating. Like you just look at D.R. Horton, as I mentioned earlier. I mean, the selling season's off to a good start. Yes, okay, maybe they had home buyer incentives, but are we going to re-accelerate areas of the economy that already got beaten up a bit?
Yeah. And as you spoke of, when we compare ourselves to the 70s, look, I was around in the 70s. We were trying to buy our first house in the 1970s. The affordability was ridiculous even compared to what we see now. So I feel for these young people who should have been buying in the last 15 years, but it's not nearly so bad. What makes this possibly, at worst, a slowflation is the demographics of this country, where there are more 32-year-olds in this country than any other age. Crime, dying to get someplace to live. And if I may, when you speak of slowflation, I was just reading that apartments will be completed this year, 2023, at the highest level in 40 years. That's going to be great news for inflation in the rental piece of CPI.
Interesting. Oh, certainly. Yeah, that demographic demand piece of it is so fascinating. Linda, thank you so much for joining us today. That's Linda Dussel, Senior Equity Strategist at Federated Hermes. Coming up, the inaugural unmanned flight of SpaceX Starship ends in an explosion. There's some good pictures there. Minutes just after the launch, Elon Musk says a lot was learned for the next test flight. We're going to have more next. This is Bloomberg.
On the vehicle, the call-out, next due now.
Great questions.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. A mixed bag of results for AT&T. The phone giant reported free cash flow that missed estimates in the first quarter, but said it's on track to meet the full year forecast. Meanwhile, the company added more monthly phone subscribers than expected. Home builder D.R. Horton reported better than expected orders in the first quarter. Tight supplies of existing homes drove buyers to build sales officers. While D.R. Horton's orders dropped 5% from a year earlier, they were still 73% higher than in the previous quarter. And another sign the slump in computer chips isn't going away. Taiwan Semiconductor forecasts worse than anticipated revenue for the current quarter. Apple's most important chip maker warned that demand from the mobile and PC industries would remain soft for now. And that's your Bloomberg Business Flash. Alex?
All right, Angel, thanks so much. It's 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond. And Silicon Valley starts this morning. And well, we're watching the SpaceX explosion that just happened in the last hour. Joining us now from Seattle is Bloomberg Technology co-host Ed Ludlow. Ed, they said the Starship experienced rapid, unscheduled disassembly. What does that mean?
It means that at an altitude of, I think, 29 kilometers above the Earth, the structural integrity of Starship, both the combined entity of the booster, Super Heavy booster, and the Starship spacecraft, something went wrong. And the main takeaway is that there was no stage separation. The plan after the 3-minute mark from launch was that Super Heavy booster would detach from Starship spacecraft, and Starship spacecraft would continue for about an hour at an altitude between 150 to 250 kilometers above the Earth, and it didn't happen. There was no separation, and what you saw in the pictures was the combined Starship system falling back down to Earth, rotating in midair, and then there was an explosion. But this was a success for SpaceX, and from their point of view, this launch really exceeded expectations.
I just have to say, next time I break something or have an accident, I'm absolutely calling it a rapid, unscheduled disassembly, absolutely using that myself. Ed, can you get into this idea that this was still a success? What did they learn? What's important here that they were able to achieve?
So, like, in the first instance, all they wanted to do was clear the launch tower for a number of reasons. You know, Elon Musk really deliberately set the bar low here in terms of what they were trying to achieve, because they've never tried to launch the Super Heavy booster before, combined with the Starship spacecraft. The reason that clearing the tower is important is, say it had exploded and not launched successfully, that could have had a really big impact on the launch pad itself, caused damage, which is expensive, but it also delays further tests. And we know that Musk has tweeted that the next test could be a couple of months away. The reason it's a success and they got to high altitude but not to orbit is that the data generated helps with the cadence of continued testing. Think about how far this has come from an idea back in 2005 to now. It's not a smooth arc when you're developing a technology for a launch system. So they will take this as being exceeding expectations, and they'll find out what went wrong and hopefully next time address it.
You mentioned the next couple months. What do you think happens between now and then?
They try again. I mean, remember, the goal here was not even to try and recover the booster. So with Falcon 9, the Starship, the SpaceX vessel we're most familiar with, they land the booster back down on Earth autonomously. In this case, had they reached orbit successfully, they plan to dump the booster into the Gulf of Mexico and splash Starship down off the coast of Hawaii. So that gives you some reality of where we are. Longer term, The idea is to reach orbit, do a sustained orbital test, and longer term, 2024 and beyond, Starship is the commissioned system from NASA to return mankind to the moon. So these are incremental steps, but they are substantive as well, because they're just part of taking Starship from a developmental system to an operational space system.
Yeah, it will be fascinating to see how quickly they can get another test up and running. Ed, so wonderful to talk with you today. That's Bloomberg Technology co-host Ed Ludlow, of course, monitoring that spaceship launch out of Seattle. Those pictures really, really incredible. Now, coming up, it is a huge day of results for regional banks. We're going to look at what the data tells us about lending and deposits. This is Bloomberg.
I've literally never seen it act like this before. This upside, sideways, weird ass. Never seen price action do this. This is really sketchy. What the hell is going on? This is really, no, this is like some kind of weird.
We're about an hour into the U.S. trading session. Equities trading a little heavy here. Abigail's tracking the moves for us. Abigail?
Yeah, Alex, it is definitely starting off a little bit weak here. We have the S&P 500 down about 0.5%. We have the NASDAQ down a little bit less than that. Moments ago, the S&P 500's worst day in about a month, which really speaks to a little bit of the slow melt-up that we've seen. But these are two of the big pressures on the various indexes. Tesla down 7.5%. Its worst day since January, although off of its lows. Of course, this as margins come in light and investors and analysts are worried that that may be the trend. They want not just the volume of cars sold, but they want it done whereas pricing and margins, earnings aren't pressured terribly. AT&T down 8.6%. The last time I looked, it was down less than this, and it was the worst day in almost a year, so it could be a worse day than that even. Free cash flow missed in a big way, plus they're talking about weakness in the wireless segment. Now, one thing, another pressure on stocks overall, even though the indexes are off the lows,
They could be yield. Now, yields on the day are down. The 2-year yield down about 9 basis points, so you can see this little bit of a round trip. But over the last 4 days this week, we certainly have yields higher, and that could bring back into question valuations. Speaking of rates higher, we just got existing home sales data, and it was a decline to the contraction that we've had over the last roughly 14 months, more than a year now. It is continuing. If we go into the Bloomberg terminal, we will see here is the decline in existing home sales for the month of March after a big pop-up, a surprise pop-up in February, even though we've had 2 months of prices going lower. And then, interestingly, in contrast to existing home sales, well, D.R. Horton up 6.7%. They put up a tremendous quarter right across the board, suggesting there's really not a slowdown for new homes, or maybe these home builders, Danny, have managed it well, but you can see the entire sector getting a bit of a lift.
Yeah, Linda Dussel talking about the demographic component. That just means that housing demand isn't going anywhere. Abigail, thank you so much. That's Bloomberg's Abigail Doolittle. Now, elsewhere, Blackstone's profit slid as deal-making was hit by rising interest rates and banking turmoil. President and COO of BlackRock, Jonathan Gray, joined Bloomberg TV earlier to talk about what he sees going forward.
We're actually in discussions today with a number of regional banks to partner with them. I think the private credit area is really at a golden moment because we do see tightening out there, and yet we have this large pool of capital to deploy, and so I think you'll see us become much more active.
Well, there was Jonathan Gray. He mentioned regional banks. We're going to talk about all of it with Bloomberg's Sonali Basak. Sonali, to start with Jonathan Gray, because of course you were speaking to him there, what were your takeaways?
There are a couple things here. If you look today, Blackstone shares are up on the day, even though assets under management were a little bit below estimates. And Danny, one reason could be they have $200 billion nearly of dry powder. That means if things get cheaper here in the market, they can buy things at pretty attractive rates here. And some really key businesses that have some secular, wind to them include credit markets. And remember, we spoke to John Gray and others as well, frankly, about this idea as credit starts to contract in the economy, firms like Blackstone can get in a deeper way. And if you take a look at it, the jump in the stock prices of Blackstone or an Ares, which by the way have brought in a lot of institutional investor money from just their funds alone, but also their stock prices, they're both up more than 20% on the year on the back of that thesis.
So I was also reading that we don't know how much these investors are going to want to go in and buy debt of the regional banks. They don't really know if the crisis is 100% over, so they don't want to load up too much. But knowing what we know now about where deposits are and earnings, is the worst over?
It's a great question today because remember, it looked like an all clear or something yesterday, right? When you saw a set of banks come out. But today is a lot messier. If you look at it, we have companies like Zions that are down more than 6%. The worst performer in the KBW Bank Index, KeyCorp, I wanted to point out also because it's down pretty significantly. And the problem is not only deposits. KeyCorp says deposits will be flat to lower, but for all of these banks, Zions, KeyCorp, Comerica, is not just deposits, but also net interest income. KeyCorp in particular, I want to point out, saying NII for the year is expected to decrease. Previously, that was expected to be an increase. So you certainly see lending under pressure at certain mid-sized and smaller banks. I also want to point out here, because remember, people are so focused on the regional banks that they have not focused as much on the big credit card companies. And American Express is the worst performer in the Dow Jones Industrial Average right now, and it's because a lot of the market had expected, oh, this is leaning towards a wealthier client. They're not going to see the same types of pressures on some of that client base. And, frankly, you do see spending volumes jumping, particularly for the Platinum card, but provisions for loan losses were a stunning $1.1 billion, which was hundreds of millions more than Wall Street had expected.
That's, to that point, we're talking to Cole Smead yesterday, who said exactly that. He liked that richer people, that this is what the product catered toward. Clearly, that still has some issues. Sonali, when it comes to deposits, do these regional banks have any clear path forward to make sure they can hold on to them and don't lose out on competition with the big banks?
If you believe John Gray and you think that, rates will stay high for a little longer, they're not going to be necessarily cut this year, then you definitely have that pressure, that movement away from the deposit bases into more money market funds and higher yielding places for consumers to go. And remember, some of these banks are already guiding that deposits will be flat or lower. That was certainly the case for the likes of KeyCorp. Comerica missed on deposits. pressure when you look at its return profile too for a lot of these banks. It's not just a matter here, Danny, of worries about really deposit flights. It's not a bank run kind of worry you're looking at when you look at these regionals. Now you're looking at the kind of pressure they could face on profitability throughout the entire year, because without that deposit funding base, then their net interest income, their net interest margins are even further under pressure than you might have initially thought.
Yeah, look at Comerica, as you were saying. All right, Shonali, thanks a lot. Bloomberg Shonali Bassick joining us. We're going to have more in the banking industry as well. Bloomberg Wall Street Week host David Weston will be joined by Bank of America Chairman and CEO Brian Moynihan from the Sell-Side Leaders Forum. That's happening here at the Bloomberg headquarters. We're going to bring that to you live on Bloomberg Television at 2:30 p.m. New York time. Coming up, we'll actually continue this conversation and also talk about solar. A new Biden administration loan program is going to bring solar energy to some disadvantaged communities. There also could be a regional bank knock-on effect, too. We'll get the perspective from the CEO of Sunnova Energy, John Berger. This is Bloomberg.
There we go. Yeah, this is a shit day. Just gonna chop around.
The government is joining forces with Sunnova Energy that installs solar panels in your home and then helps provide services to help you manage your demand. Now, the DOE is backstopping about $3 billion worth of consumer loans, is about 90% of the total, and those loans will be packaged off to investors. With us now to speak an exclusive interview is John Berger, Sunnova Energy President and CEO. John, listen, congrats. $3 billion is a very large number. The total amount of loans is $3.3 billion, so this encompasses 90%, and that's a nice backstop. John, walk us through the process to getting here, and what are you going to use those loans for?
Well, thanks for having me, Alex. Yeah, we're very excited about this. This is groundbreaking, and it really is a needle mover in a big way for not just Sonova, of course, but for the entire industry and the entire country. So, what this does is it opens up the funnel top as far as the number of and type of customers. So, for low, moderate income customers, and made in specific reference to Puerto Rico, which has been a market that we initiated and started over 10 years ago now. It really expands the availability of our service to a number of people that would not be able to have our service, especially in this type of environment that we've gone in. The second thing is the cost of capital has been reduced, and we're aggregating all these homes and providing that clean power that's in excess to the communities as well. So it does quite a lot, like I said, for Sonova, the industry, and the country.
Talk about the consumer part of this, because you mentioned lower quality consumers, but let's just dig into that. Like, we're not talking like really bad credit scores, right? Like, there's still going to be some credibility here. I'm just worried about sort of the longer term effect of that because interest rates are rising, for example.
Yes, I wouldn't say it's lower quality. What I would say is that they, some folks, we've all been there, have sometimes difficult times, particularly as more people are getting laid off, right, Alex? And that's what the Fed is looking for, is they're raising rates. And so, this is a way to counterbalance that. Look, one of the bills that you sit around at the house that you do not cut is the power bill and the water bill. And so what we're able to do is provide more affordable, more cleaner, more reliable power to these folks. And so this is really just folks that have had struggles with health bills or an auto bill or maybe a mortgage that got too high. Not folks that just can't pay any bills at all or anything else of that nature. But that's very important in this environment as the credit has gotten tighter with the failure of Silicon Valley Bank and so forth on the community bank side of things. This fills that void.
Yeah, okay, so good point on that. So what has been the effect? We're now, about a month out from what happened with SVB. What has been the effect in the solar community and the clean tech energy community in terms of that fallout and cost of capital increase?
Well, we have built, and it was one of the key reasons why Sonova, why the Department of Energy chose us. First and foremost is we're focused on service and making sure the power flows for our customers. So we have a command center in our headquarters building in Houston, and we deploy our service technicians across the country to make sure that power flows. And then secondly, if you look at our software platform, it's able to really go out there, not just take the homes and integrate them in the grid, but tell the homeowners when there's going to be higher carbon power that's being produced by the utility. So use your power that Sonova is providing you. It does that automatically. The last is that we have a strong balance sheet and cash flow statement, the strongest in the industry by far. And we have traditionally gotten our money from the asset-backed securitization market, institutional, so insurance companies, pension funds, et cetera. And so we didn't have much exposure to community banks, credit unions, as some of our competitors did. That capital has largely dried up. And again, what we're seeing is a huge amount of growth where a lot of the contractors, a lot of the customers are coming to us. And now we have that further augmented by, again, having this DOE loan guarantee. We can step in and we can, again, broaden our reach, increase our growth and address more customers. So it was really the right thing at exactly the right time with regards to the capital markets.
Hey, John, Danny here in London. Great to talk with you today. The other big macro elephant in the room is the geopolitics of it all. China and U.S. relations. You have the IRA trying to bring more of the renewable energy industry back onshore, back to the U.S. John, as things stand, considering the U.S. solar energy depends on Asia manufacturers, about 80% of its annual panel supply, can any place replace China?
Absolutely. United States of America can replace China, and we're doing it. There's a lot of capacity additions as far as for wafer cells, particularly modules. Obviously, batteries is a big part of this as well. But those announcements have already been made. All the companies that we buy panels from, at least the vast majority, either already have capacity here in the States and are expanding it rapidly, or have announced capacity additions in the United States or are about to. And so this is something that we think that when you go and look at the Inflation Reduction Act, it doesn't matter what you think of it, but it is having a material impact and it should, bringing the solar and battery industries, which have become national security important to the United States.
But John,
so absolutely.
But John,
yes.
Isn't that going to make it, at the end of the day, just more expensive? What's your counter to that?
Well, it doesn't have to. So there's a lot of incentives in the IRA to the manufacturers, but there's also a lot of incentives to our customers that we can pass on to make it even cheaper still on top of that. And I do think that there's much to be made of, too much made of, hey, China's cheaper. China's been getting more expensive for a long period of time, as we all know. And so, yes, there is some cost increase, but that's mitigated, if not eliminated, by the IRA. And certainly over a period of time, I think that we'll be able to have cost parity with anybody in the world.
John, how long would it take for the U.S. to replace China? Seems like a big pull, a big load at this point, considering where the industry is.
It's going to take some time. Look, you always shoot you straight. Look, this is not going to happen overnight. It's not going to happen next year, but it is a ramp. It's not that you have to wait 5 years and all of a sudden the capacity shows up here, but it is a ramp, and it is a steep ramp at that. And what I would also say is that, it's something that as we bring these technologies here to this country, where in many cases we invented them, we're going to be able to have more innovation here. So we're going to be able to do some things that we can't contemplate as far as cheaper, newer technologies on the solar, on the battery, and the controls for demand for homes and businesses. So how do you lower that power demand? Yeah. That is really taking off. And then electric vehicles as well, and the chargers, which we supply power to our customers through providing power service to their homes and businesses. So there's a lot of innovation that's going to happen that's going to accelerate this.
John, in the very short term, the House Ways and Means Committee is trying to undo a 2-year moratorium on tariffs on products coming from China. Are you worried about that? Does that affect the very short-term view here?
Well, I don't think that's a very good policy at all, to say the least. We've got to give some time for the industry to respond. The incentives are in place. Companies like mine are deploying billions of dollars of capital to make this happen. So the train's rolling fast down the tracks already. That would be extremely counterproductive for, quite candidly, just some political points. And I'm not really sure that they're that good political points at the end of the day. This is happening. We need to give it some time to make it happen. What I would also stress is that because of the panels that we buy are what we call high efficiency, or the higher end, and yes, we pay more for them. That's been true for years and years and still is. It will not be us that is really impacted. It will be the utilities that will be impacted. Anything in front of the meter, so the utility scale industry will be disproportionately, by far, negatively impacted by this. So I think that some of the utilities and the unions of the utilities will be very involved in this and making sure that American jobs, and that's what that's
traps everywhere,
jobs for the utility scale industry are at risk if that is indeed passed and signed by the president.
John, a really fascinating insight, and of course I would expect nothing less.